Stop calling it retirement savings. It's the largest compulsory wealth transfer machine in Australian history, and almost nobody who's paying into it understands how it actually works. Every 2 weeks, a percentage of your labor disappears from your paycheck before you ever see it. No vote, no choice. You're told it's for your future, but you can't touch it for 40 years. You don't control where it's invested, and a slice of every dollar is quietly taken by fund managers, whether your balance goes up or down. Right now, that machine holds $4.4 trillion. It owns airports, it owns toll roads, it owns pieces of companies on almost every continent on Earth. And almost none of the people funding it were ever asked if they wanted in. Today, we're exposing how a single law, passed in 1992, turned every working Australian into an unwitting investor in a system most of them will never fully understand, and who actually benefits when your money disappears into it for decades. Before we get into it, if you're the kind of person who wants to understand where your money actually goes, not just where you're told it goes, subscribe now. This channel breaks down the systems that quietly shape your wealth, your wages, and your future, and you don't want to miss what's coming next. To understand how strange this system really is, you have to go back to a time when most Australians had no retirement savings at all, beyond a government pension. Through most of the 20th century, superannuation was a privilege, not a right. It belonged to public servants. It belonged to white-collar professionals at large corporations, the kind of people who worked for one employer for 40 years and retired with a gold watch and a defined pension. For everyone else, the factory worker, the shop assistant, the tradesperson, retirement meant one thing: the age pension, funded directly by taxpayers, means-tested, and never designed to be generous. By the 1980s, this was becoming a demographic time bomb. Australia's population was aging. Life expectancy was climbing. And the pension bill, paid entirely out of general taxation, was on a trajectory that governments knew, even then, would eventually become unsustainable. Something had to change, and the labor movement, not the banks, not the finance industry, was the surprising force that pushed it forward. In 1985, the union movement, led by the Australian Council of Trade Unions, made a calculated trade. Instead of demanding a full wage increase during a period of national wage restraint, unions negotiated for employers to instead pay 3% of a worker's wage into a superannuation fund. It was a compromise born out of economic necessity, part of the broader prices and incomes accord between the Hawke government and the union movement. Nobody involved in that negotiation was thinking about global capital markets. They were thinking about retirement dignity for factory workers and cleaners, who would otherwise retire with nothing but a government check. That 3%, buried inside industrial awards, lifted private sector super coverage from around 32% of workers in 1987 to 68% by 1991. It was working, but it was patchy, uneven, and entirely dependent on which industrial award covered you. If your job wasn't unionized, or wasn't covered by the right agreement, you could still retire with nothing. The Hawke-Keating government decided patchwork wasn't good enough. On the 1st of July 1992, everything changed. The superannuation guarantee became law. For the first time in Australian history, it was not optional, not negotiated, not dependent on your union or your employer's goodwill. Every employer, by federal law, was required to contribute a percentage of every eligible worker's wage into a superannuation fund, on top of their salary, whether the worker asked for it or not. The starting rate was modest, 3% for larger employers, 4% for smaller ones. But the mechanism was the revolutionary part. This wasn't a tax. The government never touched the money. It went directly from employer to a private investment fund, professionally managed, compounding, invested in shares, in property, in bonds, quietly building an asset base for a worker who, in most cases, wouldn't see a dollar of it for 30 or 40 years. Think about what that actually means at scale. Multiply that mandatory contribution across almost the entire Australian workforce. Millions of people who had never bought a share in their life, who had never opened an investment account, who in many cases couldn't tell you the difference between a bond and a blue-chip stock. Overnight, almost by accident, Australia had turned nearly every working citizen into a shareholder in the global economy. The rate didn't stay at 3%. Governments, largely because the fiscal logic was so compelling, kept raising it. By 2002, it reached 9%, where it sat, frozen, for over a decade. In 2012, The Gillard government legislated a path toward 12%. That final increase took full effect in July of 2025. Every single percentage point increase, multiplied across a growing, aging workforce, compounding year after year in investment markets, that is the engine that built the number we started with. $4.4 trillion, up from just $148 billion the year the system began. Roughly 1.5 times the size of Australia's entire annual economic output, tracked from a pension pool most working Australians barely think about. Here's where the story stops being about retirement savings and starts being about raw economic power. When you force an entire nation to save at scale, you don't just build a retirement fund, you build a permanent, self-replenishing river of capital that has to go somewhere every single week. And where that river flows changes the ownership structure of an entire economy. Today, roughly half of everything in the superannuation system is invested outside Australia. International shares alone make up around 32% of the average portfolio, more than domestic Australian shares. A decade ago, only about 35% of the pool sat offshore. Australian super funds now hold stakes in global technology companies, in European infrastructure, in American real estate. A worker stacking shelves in a Brisbane supermarket may, without knowing it, be a part owner of a toll road in Chicago or a data center in Frankfurt. But the domestic footprint is just as staggering. Superannuation funds, either directly or through the infrastructure vehicles they invest in, hold ownership stakes in some of Australia's most essential public assets: airports, ports, electricity networks, toll roads. Assets that used to be owned by governments or by narrow groups of private investors are now, indirectly, partly owned by tens of millions of ordinary workers through their compulsory super accounts. The system received $226 billion in new contributions in the most recent year alone, against $143 billion paid out in benefits. A net inflow of over $70 billion that has to be deployed into markets, year after year, regardless of what those markets are doing. Now, here's the part that complicates the popular myth. Many people assume this constant wall of forced buying is single-handedly inflating the stock market, pushing up share prices no matter what. The data tells a more nuanced story. Of that net inflow, researchers estimate only around $17 billion a year actually reaches the Australian-listed share market, roughly 1% of daily trading volume nationally. Super funds are, in the day-to-day churn of the market, closer to price takers than price setters. But zoom out to the full picture, and the system's annual inflows still exceed all new listed equity raised on the Australian market in a given year, and exceed the value of every commercial property transaction completed across the entire country. It's not moving the market minute to minute. It's reshaping who owns the economy, decade to decade. Who wins in this system, and who doesn't, is not evenly distributed. Compound interest rewards time above almost everything else. A worker who started their career in 1992, at the very beginning of compulsory super, has had over 3 decades of compounding growth working in their favor. A worker who started their career in 2015 has had a fraction of that runway. The median super balance for Australians nearing retirement, in their early 60s, sits around $240,000, a substantial sum, but one that varies enormously depending on income, gender, and career interruptions. Women, who statistically take more time out of paid work for caregiving, retire with significantly lower balances than men, a gap the compulsory system was never designed to correct, because it is calculated purely as a percentage of wages earned. There's also a genuine counter-argument worth taking seriously. Some economists argue that compulsory super, by locking away a slice of every paycheck for decades, simply substitutes for wage growth that workers would otherwise have received directly, in cash, sooner. If your employer is required to pay 12% of your wage into a fund you can't touch until you're 60, some of that money, the argument goes, likely comes out of what would otherwise have been your take-home pay today. It's not free money conjured from nowhere. It's a forced trade-off between spending today and wealth tomorrow. And reasonable people disagree about whether every worker, given the choice, would have made that same trade voluntarily. But whatever your view on that trade-off, the scale of what it built is not in dispute. Australia now manages the 4th largest pension pool on Earth, despite having only the world's 14th largest economy. On a per-person basis, Australians are, statistically, the best-funded retirees in the world. And the trajectory keeps climbing. Analysts project Australia's superannuation system will overtake both the United Kingdom and Canada to become the second largest pension market globally within the next decade. Some long-range estimates put the system's value, decades from now, in the tens of trillions of dollars. Step back, and the real story here isn't really about retirement at all. It's about what happens when a government decides that ordinary citizens, collectively, should own the machinery of the economy they work inside. Nobody sitting in that 1985 wage negotiation, trading a pay rise for a 3% contribution, was trying to build the seventh largest pension pool on the planet. They were trying to make sure a cleaner or a factory worker didn't retire with nothing. But small, compounding decisions, sustained over enough decades, don't stay small. They become structural. They become the invisible architecture underneath an entire nation's wealth. Every fortnight, without a headline, without a vote, without most people even glancing at the number on their payslip, that architecture gets a little bit bigger. And somewhere in an airport terminal, on a toll road, inside a global equity index, a small piece of it now belongs to you.